Today we have big news coming from a company that I haven't covered in a very long time, and that is the Walt Disney Company, stock ticker DIS, trading at $92.58 per share. They just recently announced that they're going to be bringing back their dividend payment after cutting it and not paying any dividends for around 3 years. So if we jump back over to Seeking Alpha and go to that dividend history, we can see they used to pay out a semi-annual dividend, but they cut it in January of 2020. Now, a semi-annual dividend means basically they pay out dividends twice a year. We can see before the dividend cut, it looks like it was around 88 cents per share, again, twice per year. And if we jump back over this headline, we can now see they're going to be paying out around 30 cents per share. And again, I'm assuming this will be another semi-annual dividend. And if we look at what Bob Iger stated earlier this year in February, he said the company planned to bring back the dividend back by year end, which it is clear now that they did do, and that while it would initially be a modest dividend, the payout would grow over time. So far it looks like Disney has followed through with this statement. They did bring back the dividend, and no doubt it is a modest dividend, especially when you compare it to where the dividend payments used to be. Pretty big jump down, going from around 88 cents per share all the way down to around 30 cents per share. But from a dividend investor standpoint, there is a lot of people excited just to see that dividend come back. Now, if we jump back over to the summary tab and we look at how Disney's performed over the past month, it's up almost 14%, but really that's not due to the news of the dividend. If we look at how the S&P 500 has performed over the past month as well, we can see it's up around 9.44%. So really, the result of Disney bouncing up is just the result of the market doing really well over the past month in general. Now, make no doubt about it, Disney is still facing a plethora of problems with their business model, most notably a mountain of debt and woke overkill, and also problems with their streaming services and ESPN. There have been some positives as well over the past few months. If we scroll up, there's a couple good points that this article made on Seeking Alpha. We can see Q4 earnings release showed a hefty year-over-year earnings beat, an increase in Disney Plus subscription, good park numbers, and increases in free cash flow. But the problem is when we talk about increases in free cash flow, let's go ahead and look at this charted out. We can see prior to around 2019, free cash flow was growing at a rapid pace. It got all the way up to around $9 billion, but it has dropped dramatically since that time period, and it really hasn't recovered anywhere close to the levels it was at before 2019. This was obviously a big reason for the dividend cut. It just wouldn't have been sustainable to continue paying out those dividends with such low free cash flow levels. So while it's nice to see the dividend is brought back, is the free cash flow high enough to continue to sustain growing dividend payments? And I think that's a big question we need to answer in today's video. So let's go ahead and jump back over to Seeking Alpha, and I want to start digging into these financial statements and see if we can find any meaningful insights. Now, the first thing we'll glance at is revenues over the past decade. And for the most part, it looks like it's been pretty good. It's grown pretty large amount, going from around 48 billion to around 88 billion for the trailing 12 months. Now, here's the problem. If we keep scrolling down and look for net income, we can see net income has not grown anywhere near those levels, and in fact, it's declined over the past 10 years. So although revenues have been increasing, due to declining margins and extra expenses, we can see net income has declined pretty dramatically. And in fact, if we look at it charted out, we can see just how dramatic the declines have been. And one of the things I noticed as I was digging into the income statement, if we scroll up, one of the places that you'll see a huge problem for Disney right now is the increase in interest expenses. Now, when you see this as a problem, this is typically due to the debt levels of the company. We can see interest expense has increased dramatically over the past decade for Disney. So one of the things I want to do now, jump over to the balance sheet and let's look at these total debt levels. Now, something we can see, cash and cash equivalents has increased by a pretty good amount over the past decade, which you could argue makes it a little more acceptable for the debt to increase over time. But let's go ahead and scroll down and see if we can find the total debt levels. It will be near the bottom. Right here, we can see total debt. And again, just like we expected, it has increased dramatically over the past decade with over 50 billion in debt currently, which again was a big problem with the interest expenses. So obviously, total debt increasing and net income decreasing, not a good combination. But a big question I want to look at as well is what is the free cash flow doing? What's the free cash flow per share doing? If they're able to grow free cash flow over time, I feel comfortable that this company can recover back to its pre-pandemic levels. So if we scroll back down on the cash flow statement, here we have free cash flow per share. In my opinion, one of the absolute most important metrics to look at for any company. And in 2014, free cash flow per share was sitting at around $3.72, and it's jumped around quite a bit. We saw a good time period where it increased over time, but again, dropped dramatically in 2019, and it hasn't recovered back to the levels that we saw before the pandemic. And for the trailing 12 months, it's sitting at $2.68. So one of the things I want to do is I want to project how much free cash flow are they going to have to use to pay out their dividends. So let's go ahead and jump over to my stock valuation spreadsheet, and we'll go ahead and run through this. And like always, there's a few different valuations on this spreadsheet, and if you'd like to download it and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. Now let's go ahead and come up here and plug in DIS and hit enter, and you can see all of this data will automatically load in. Now I want to go ahead and actually zoom in a little bit, touch on this dividend data just a little bit. Again, they're paying out 30 cents per share semi-annually right now, which comes out to around 60 cents per share every single year, and that currently gives them a dividend yield of just 0.65%. But again, I want to find out how much free cash flow are they having to use to pay out this dividend. So this is a relatively easy formula. Let's go ahead and plug in FCF per share right here and jump back over to Seeking Alpha. And like we saw for the trailing 12 months, it's sitting at $2.68. So I'll plug in 268 right here, and then we saw they are paying out 60 cents per share every single year in dividends. So I'll plug that in here, 0.6. This is all the data we need to find out. If we come down here, we can do a simple formula. We'll take the dividend, divide it by FCF per share, and hit enter, and we can see how much free cash flow they're currently having to use, and it's around 22.39% of their free cash flow of the trailing 12 months will have to be used to pay out dividends as of right now. And so while that's a very low free cash flow payout ratio, and I know a lot of investors are excited to see the dividend come back, I do have to wonder, is that the best use of their free cash flow as of right now when their debt levels are continuing to grow? The company again also stated that they plan on increasing those dividend payouts over time. But again, I can't help but wonder if this is the best use of their capital right now. But let's go ahead and zoom back out. We'll look at some of these other metrics on our stock screener. Again, we can see analysts currently have a target price of around $104, institutional ownership around 64%, and a pretty high beta sitting at 1.32, so you actually will see quite a bit of volatility with this company. The 20, 50, and 200-day moving average is now all in the positive. Let's go ahead and jump over to our first valuation, which is Graham's valuation. This is a valuation model invented by Benjamin Graham, and it values a company basically based off of how the earnings per share will grow over time. So we can see we have our forward-looking earnings per share for Disney right here, and then we have our growth rate projection. And actually right now, if you look at analyst projections, earnings are projected to grow at a pretty high rate. We then multiply that by 4.4, which is the average yield of AAA corporate bonds, and divide by Y, which is the current yield on AAA corporate bonds. It's come down just a little bit over the past month, but it's still sitting at a relatively high number considering where it's been over the past few years. Now this will drive down the valuation quite a bit, the high current yield on AAA corporate bonds, but when we plug all of this in, we come to an intrinsic value of $90.92 per share, very, very close to that current trading price of $92.58. Now let's go ahead and jump back over to our next valuation. Now will be the discounted cash flow analysis, and like we've already seen, the free cash flow levels for Disney have really dropped dramatically, and obviously the DCF model has suffered as a result of this. If we look at this, we can see we saw a very nice period of free cash flow growth, and then it pretty much just fell off of a cliff. So for me, the question really isn't how much of a growth rate projection do we need to apply to Disney. The question is how fast can they get to their pre-pandemic levels? And if I plug in a 20% growth rate right here, we can see even then, based off of last year's free cash flow, we still only come to a discounted cash flow price per share of $33.68. So again, we really don't even need to be thinking about how fast will they grow that free cash flow. The question is, when can they get it back to those pre-pandemic levels, and what's it going to take to get it there? I also think the question, like I mentioned earlier, we should be wondering is how are they going to be using that free cash flow? And like we saw in our stock screener, as of right now, around 22.39% of it is going to be used to pay out dividends, and it might be higher if they're going to continue to increase those dividend payouts and we don't see an increase in free cash flow per share. So although I don't hold any Disney stock, if I was an investor in Disney, I would want to see them focus on paying down more debt. Now, the next valuation we typically look at is the multiples valuation, but there's really just not any company like Disney. They have revenue streams from so many different areas. It just makes it hard to use a multiples valuation in that scenario. So that means the last valuation that we would typically use is the dividend discount model. Now, this is a pretty unique valuation in this scenario because obviously they just now brought back their dividend payment of around 30 cents semi-annually, meaning around 60 cents per share every single year. If we jump back over to Seeking Alpha, let's go ahead and just run it through an example projection of the dividend discount model. Again, we can see if we look at this dividend history, they are paying out around 88 cents per share semi-annually before they cut the dividend. Now, just as an example, let's say we plug in 0.88 here again. Let's Let's pretend that's where it was right now, and just assume that maybe they're able to increase their dividend at around 5% a year moving forward. We can see even then the dividend discount model price per share would only give us around $52.80. So even as of right now, it's pretty clear they're still a long way off from providing their shareholders with a lot of value in the form of dividends. But with that being said, this still really isn't the fairest valuation in this scenario. Really, the only fair valuation in this scenario I think would be Graham's valuation. And again, it looks like they're trading pretty close to fair value in that scenario. So while it's hard to use a lot of these valuation models just due to the situation that Disney is currently in, as for me, even with them bringing back the dividends, it's still not really a company I'm interested in at this time. They obviously still have a lot of problems that they're having to work through, like I pointed out earlier. Obviously, we have the problems with debt, the woke overkill, and problems with linear TV and ESPN. Now, there are some options. They could consider selling off some of their assets, such as ESPN, to help pay down debt, but we'll see if that's an option for them in the future. But again, as for now, for me, them bringing back the dividend is definitely not something that's going to make me interested in investing in this company at this time. And while it's a bumpy road ahead, I do think it's possible for Disney to return to where they were in around 2018 and to see high levels of growth in the future. But as for right now, I still think they have a pretty rocky road up ahead. But there you go. There is my analysis on the Walt Disney Company. Go ahead and let me know what you think in the comments down below. And like always, if you'd like to be able to download the spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.